Most people let their money sit in savings accounts, earning pennies while inflation eats into its value. Meanwhile, a small group of investors collects monthly paychecks, not from a job, but from dividends. So what if you joined them? What if you invested $100,000 in the top 5 monthly dividend stocks? In this video, I'm going to show you and John 5 of the most consistent monthly dividend stocks, companies that have not only survived multiple market cycles, but have also increased shareholder payouts year after year. I've ranked these 5 stocks from number 5 to number 1 based on how much income they can generate. You'll see exactly how a $100,000 investment in each performs across 1, 10, 20, and 30 years, and which of these can truly replace a salary-level income. And in the end, I'll show you a monthly dividend stock that can turn a single $100,000 investment into a $2.8 million portfolio paying over $20,000 in monthly dividend income. Before we jump into the list, though, it's important to really understand why monthly dividend investing is such a strong strategy and how it's different from the way most people invest. See, most companies pay dividends every 3 months. That means you're only getting 4 payments a year. But monthly dividend stocks pay you every single month, 12 times a year. And while that might not sound like a big deal at first, it actually makes a huge difference when it comes to how fast your money grows. Here's why. Each time you get a dividend, you can use it to buy a little more of the same stock, and those new shares start earning dividends too the very next month. That cycle repeats again and again, turning your portfolio into a self-growing income machine. That's the magic of compounding. Your money earning money, and that new money earning even more. Let's make it real for a second. Say you invest $100,000 into a stock that pays a 6% annual yield. In your first year, you'd earn about $6,000 in dividends. If you reinvest those dividends, your total balance grows. So in year 2, you're earning roughly $6,360. By year 3, that's around $6,740. You didn't add a single extra dollar of your own, yet your income keeps growing automatically. Now, that example uses annual compounding, but with monthly dividend stocks, your reinvestments happen 12 times a year instead of just once. That means your money starts earning on itself faster and more often, like giving your portfolio 12 tiny growth boosts instead of just one big push at the end of the year. Over time, that simple timing difference adds up to a noticeably bigger balance and a much bigger paycheck. And when you're comparing dividend stocks, there are really 3 things that matter most. The dividend yield, how much income you get now, the dividend growth, how fast that income increases over time, and share price appreciation, the part that boosts your overall wealth with the investment. The 5 stocks I'm about to show you and John check all 3 boxes. They pay a steady monthly income, they've proven they can grow it, and they've built real long-term value. At number 5, we have Agree Realty Corporation with the ticker symbol ADC. It's a real estate investment trust, or REIT, that focuses on owning retail properties leased to big, essential businesses like Walmart, AutoZone, and Dollar General. In other words, it rents spaces to companies that people rely on no matter what's happening in the economy. That steady demand gives Agree Realty something every income investor loves: predictable cash flow. Financially, this company plays it safe. Its current ratio is 1.12, which means it has a bit more cash and assets than it needs to cover its short-term bills, which is a good sign. The quick ratio is 1.06, which tells us it can pay its immediate obligations without having to sell anything major. Then there's the debt-to-equity ratio sitting at 0.57. That simply means it doesn't borrow much compared to what it owns. It's not over-leveraged. The interest coverage ratio is 2.61, meaning it earns more than twice what it needs to cover its loan interests. Plenty of breathing room. And finally, the debt-to-EBITDA ratio is 5.67. Think of that as a way to measure how many years it would take to pay off all its debt using its current earnings. For a REIT, 5.67 is comfortably in the safe zone. Another sign of confidence, institutional investors hold over 98% of the company's total shares, leaving just a small fraction in the hands of insiders and the public. This level of institutional ownership typically reflects long-term stability and investor trust. From a market standpoint, Agree Realty demonstrates low volatility with a beta of 0.07, meaning its stock moves far less than the broader market, a valuable trait for investors seeking steady income. There's some short interest at around 9.84%, but nothing alarming. Performance-wise, the stock has rewarded patient investors. Over the last 5 years, it's up around 13%, and over the last decade, it's climbed roughly 126%. That kind of slow and steady growth is exactly what long-term income investors look for: consistent progress built on reliable business fundamentals. Now, focusing on what makes Agree Realty appealing to income investors, it offers a dividend yield of 4.26% with an annual dividend growth rate of 5.46% and a share price appreciation of 8.9% per year. So, if you invested $100,000, your investment would grow to about $113,160 after 1 year. $326,380 after 10 years, $967,332 after 20 years, and $2,677,174 after 30 years. At that point, your annual dividends would reach roughly $37,417 or about $3,118 every month, a reliable stream of passive income built on steady returns and financial discipline. Over 30 years, this investment would have added about $2,577,174 in total growth. That includes around $2,089,476 from the stock's price going up. That's what we call capital appreciation. And another $487,698 from reinvesting your dividends, which is basically your money earning more money each month. At number 4, we've got Main Street Capital Corporation with the ticker symbol MAIN, a true favorite among income investors. MAIN is what's called a business development company, or BDC for short. Basically, it lends money to small and mid-sized American businesses that are growing but can't always get loans from big banks. In return, Main Street earns interest on those loans like a bank and sometimes even takes a small ownership stake in those companies. Then, instead of keeping all that income, it pays a big chunk of it back to its investors through monthly dividends. Right now, the stock trades at around $58.38, near the higher end of its 52-week range between $47 and $67.77. Over the last 10 years, it's been up about 94%. Its price-to-earnings ratio sits at 14.57, which means investors are paying about $14.50 for every dollar of the company's earnings. That's a pretty fair valuation for a stock that delivers both strong income and solid growth. Financially, Main Street is in great shape. Both its current and quick ratios sit at 2.09, meaning it has more than enough liquidity to cover short-term expenses. Its debt-to-equity ratio is 0.77, showing it uses moderate leverage, just enough to enhance returns without overextending itself. With an interest coverage ratio of 3.75, it easily earns enough to pay its debt obligations, which gives investors peace of mind that dividends are well supported. Ownership is well diversified, too. Institutional investors hold about 22% of shares, everyday retail investors own roughly 74%, and insiders hold around 4%. That's a healthy mix that reflects both professional confidence and strong retail trust. In terms of risk, Main's beta is 0.7, meaning the stock moves less than the overall market. Steady, but not dull. Its short interest of just 5.58% shows there's very little negative sentiment, and an Altman Z-score of 1.75 signals a manageable level of financial risk typical for a well-run lender. The company currently pays a dividend yield of 7.53%, with a compound annual dividend growth rate of 3.76% and annual share price appreciation of 7.31%. So here we go. If you and John invest $100,000, here's how it could play out. After 1 year, your investment is projected to grow to about $114,840, $362,424 after 10 years, $1,104,852 after 20 years, and $2,980,331 after 30 years. By that 30-year mark, that investment would be paying around $71,553 in annual dividends, or roughly $5,963 per month. Over those 30 years, the total value added comes to roughly $2,880,331, about $1,933,575 from price growth, and $946,756 from reinvested dividends. At number 3, we have Realty Income Corporation with the ticker symbol O, a company so dependable that it's literally branded itself as the monthly dividend company. And it's not just a slogan. Realty Income has paid and grown its monthly dividend for more than 30 straight years. That kind of consistency is rare, even in the world of REITs. It owns around 15,600 commercial properties leased to strong tenants under long-term net lease, often triple net, agreements, meaning the tenants cover most of the property expenses like taxes, insurance, and maintenance, while Realty Income simply collects reliable rent. Right now, the stock trades around $58.84, comfortably within its yearly range. Over the past decade, it's grown about 17.9%. And even though real estate markets go through ups and downs, Realty Income's track record has kept investors confident. The company reports funds from operations, or FFO, of $4.27 and trades at about 13.78 times that figure, which is considered a fair price for such a large, well-managed REIT. Financially, Realty Income is in strong shape. Its current ratio is 1.5 and the quick ratio is 1.04, showing it has enough short-term assets to easily cover immediate bills. The debt-to-equity ratio sits at 0.74, meaning it uses debt responsibly. Its debt-to-EBITDA ratio of 5.9 and interest coverage ratio of 2.23 tell the same story. The company can comfortably handle its debt without stretching itself thin. In short, it's a textbook example of a company that knows how to manage growth without putting shareholders at risk. Ownership is another big confidence signal. Institutional investors, the large funds and money managers, hold about 78% of the shares. That's a strong endorsement from professionals who look for dependable income-producing assets. The rest is held by the public, while insiders own only a tiny portion. And with a market cap of nearly $54 billion, Realty Income is one of the biggest and most trusted names in the REIT world. From a risk standpoint, Realty Income is among the lowest volatility dividend stocks in the market. The short interest stands at 4.24%, while its 24-month beta of 0.2 indicates that it moves far less than the broader market. Now, when you combine all that stability with the power of compounding, things get really interesting. Realty Income pays a 5.55% dividend yield, grows those dividends about 3.9% per year, and sees about 2.35% annual price appreciation. It's not flashy, but over time, that combination can snowball into something big. So if you invested $100,000 and simply left it alone, your portfolio could grow to around $107,900 after 1 year, $222,031 after 10 years, $539,932 after 20, and roughly $1,458,453 after 30 years. By then, your investment would be paying around $113,895 a year, or around $9,491 every single month. Over that 30-year period, your total growth would be around $1,358,453, with $318,645 coming from the stock's price increase and $1,039,809 from the reinvested dividends. Though the valuation added is on the low side, it makes up for it with higher monthly dividend income. Okay, next, I'll show you a stock that pays more than Realty Income and still delivers twice the returns. And in the end, I'll show you a monthly dividend stock that can turn a single $100,000 investment into a $2.8 million portfolio paying over $20,000 in monthly dividend income. At number 2, we have Sabine Royalty Trust with the ticker symbol SBR, one of the most unique monthly dividend investments on the market. A royalty trust is not a traditional operating upstream company. It holds royalty and mineral interests in U.S. oil and gas production, then distributes a large portion of that income to its unit holders every month. Because it doesn't run drilling operations like a typical company, it has far lower overhead and operational cost risks compared to many other energy players. Sabine currently trades around $67.74, with a 52-week range of $58.25 to $84.39. Over the past 5 years, its value has increased by approximately 133%. Sabine operates with a structure that's extremely lean and transparent. It has no long-term debt and virtually no overhead. This means almost every dollar of royalty income flows straight to unit holders. The trust's financial position reinforces this efficiency. Both its current and quick ratios stand at 31.48, showing substantial liquidity relative to its obligations. There's no debt-to-equity ratio, no leverage metrics like debt to EBITDA, and no interest coverage ratio to report because the trust simply doesn't borrow money. This creates a highly secure financial profile free from the risks that typically accompany debt-funded operations. Ownership is mostly in the hands of everyday investors, not big institutions. Around 82% of the units are held by the public, with 13% owned by institutions and about 4% by insiders. On the risk front, Sabine remains relatively conservative for a commodity-linked asset. Short interest is just 0.66%, and with a 24-month beta of 0.56, the trust moves less than the broader market, offering moderate volatility compared to pure exploration and production companies. The days-to-cover ratio of 1.91 suggests low short-term trading pressure, reflecting investor confidence. However, its main sensitivity remains tied to oil and natural gas prices, which can influence monthly distributions. Okay, so let's look at what that means over time. Sabine offers a 6.39% dividend yield, grows its payouts roughly 5.82% per year, and its share price appreciates about 6.99% annually. If you invested $100,000, your portfolio could grow to around $113,380 after 1 year. $341,072 after 10 years, $1,095,857 after 20, and about $3,337,885 after 30 years. By then, you'd be earning roughly $135,940 each year, or about $11,328 every single month from this one investment. Over those 30 years, your total gains would reach about $3,237,885, including $1,893,879 from price growth and $1,334,006 from reinvested dividends. And finally, we've arrived at number 1, the top performer among all 5, the stock with the highest yield, resilient fundamentals, and a dividend profile that turns consistent payouts into exponential long-term growth. At the top of the list is Gladstone Capital Corporation with the ticker symbol GLAD, a business development company, or BDC, that provides debt and equity financing to lower middle market U.S. firms. The company specializes in senior secured loans and occasional equity investments, allowing it to generate consistent high-yielding income that's distributed to shareholders as monthly dividends. GLAD's focus on lending to established, cash-generating private businesses enables it to balance risk and return effectively while maintaining steady dividend coverage through multiple market cycles. Gladstone Capital trades at $20.12, within a 52-week range of $19.29 to $30.43. The stock has gained about 32% over the last 5 years, showing moderate but stable appreciation despite broader market volatility. With an earnings per share of $2.01 and a forward price-to-earnings ratio, or PE ratio, of 10.02, GLAD remains attractively valued within the BDC sector. The company pays a forward annual dividend of $1.98 per share, yielding 9.82%, which places it among the highest-yielding monthly dividend payers currently available. That high yield isn't a fluke. It's backed by recurring loan income and the company's careful approach to credit risk. GLAD doesn't chase risky loans just to increase returns. It sticks with established businesses that can comfortably make their payments, which keeps its dividend stream reliable. The company's financial position supports its income generation strength. GLAD maintains a current ratio of 3.0 and a quick ratio of 2.7, indicating substantial liquidity to cover short-term obligations. The debt-to-equity ratio of 0.58 shows moderate leverage, an appropriate level for a BDC that utilizes debt to enhance returns without compromising financial stability. Its interest coverage ratio of 2.95 highlights solid debt servicing capability, suggesting that the company's earnings adequately support its financing costs. Ownership data reinforces investor confidence. About 10% of shares are held by institutions, 4% by insiders, and the remaining 86% by regular retail investors, people who value monthly income. With a market cap of around $449 million, GLAD isn't huge, but it's built a loyal following thanks to its dependable payouts and disciplined lending style. On the risk side, there's not much to worry about. The short interest is only 2.57%, meaning very few traders are betting against it. Its beta of 0.69 shows it moves less than the market, and an Altman Z-score of 1.61 signals a stable footing, cautious but well within the comfort zone for a lending company. Sure, rising interest rates or credit defaults could affect short-term results, but GLAD's diversification across industries and its careful underwriting help keep that risk in check. GLAD offers a 9.82% dividend yield, which is the main driver for investors. It has an annual dividend growth of about 1.66% and share price appreciation of around 1.14% per year. If you invested $100,000, your portfolio would grow to about $110,960 after 1 year, $288,915 after 10 years, $875,776 after 20 years, and a remarkable $2,791,702 after 30 years. By that point, you'd be earning roughly $283,101 every year, or about $23,592 every month, all from dividends alone. Over that 30-year span, the total value added would come to about $2,691,702, with roughly $2,438,820 coming from reinvested dividends and only $252,883 from the stock's price growth. Want even more value? Click the video on the screen to find the best index fund that can turn a $100,000 investment into a $12 million portfolio.